All right, guys, we're going to talk about 1031 exchanges today. Now, we already talked about, hey, you've got a property. If you want to sell it, you're going to have capital gains, right? You're going to pay capital gains. Part of that will be taxed, and then you have less money to go and reinvest and continue to build your wealth. That's where the 1031 exchange steps in, okay? It's a really, really cool way to continue to kick the can down the road in terms of taxes. So we're not getting out of paying taxes. I want to make that really clear. We're not getting out of paying taxes. We're simply deferring taxes till later. And if we defer long enough and pass on our property to our heirs and they get a step up in cost basis, then potentially we can get out of paying taxes overall. But here's how the 1031 exchange works. It allows you, upon the sale of a property, it allows you to defer the gain so you don't pay the taxes as long as you take that money and reinvest it into another similar like kind property. All right. Now, I'll say this at the end, but I'm going to say it at the beginning. If you want to do a 1031 exchange, then you better hire a professional to help you do this. This is not something you want to go DIY. Just get a professional and pay them their money so they can help you not screw this up. Okay. It's really, really important to do it that way. So essentially, if you exchange like kind property, okay, the original rule is like two people, they each have a property and they trade properties. For a number of reasons, you probably can see that that's impractical. And so there are other methods to do it. I'll cover that in a minute. But essentially, it's real estate. You could swap a home for land. You could swap a home for a bigger home, or a home or a duplex for a fourplex, or a fourplex for a multi-unit apartment complex. Okay. So it doesn't have to be like the exact type of property. There are restrictions there, but there is some give there, right? There's some leeway. So because just swapping properties straight across is difficult and probably impractical, there are other methods, right? There's delayed method. There's a three-party or starker exchanges. So the most common is that you get a third party, you sell the property, the money goes to the third party to hold it, right? They hold it in escrow. If you receive the money, 1031 is, you're going to blow it up. So you can't receive the money, has to go to a third party. They hold on to the money while you identify a property and find it, and then they send the money to go make the purchase. So that's the most common way, but there are a few other methods that can also work. Now, the timelines are really important. Okay, you can't just say, hey, I'm going to do this and then wait 5 years to reinvest the money. No, there are very strict deadlines. You have to notify the IRS in advance that you're going to be doing this. And so 45 days from the day that you sell your property. So within 45 days, you have to identify 3 potential properties. This works as long as you end up purchasing one of them. Okay, so you can't just pick 3 properties out of the air and say, oh yeah, I'll probably buy one of these. No, you actually have to end up buying one of them. Okay, so this is serious business. You probably, before you sell, you probably need to have a property in mind that you are going to purchase or get into next. Okay, it's not something you do flying by the seat of your pants. So within 45 days of sale, you have to identify at least 3 potential properties and end up closing on one of them. So they have to be actual options. And then within 180 days from the sale of the property, you have to close on the new property. So you have 180 days to sell, find a new property, 45 days to find the new property, and then 180 days total before you close on the new property. All right. If you do this properly, then you will avoid the capital gains. You can roll them into the next property and then do the same thing. So let's say you get a property, you do bonus depreciation, accelerated depreciation for like 5 years. You just depreciate the heck out of that property, right? So you take a ton of losses, you deduct against your other income, and then, right, it lowers your cost basis. You're going to be charged on the capital gains tax. But instead of selling, you do a 1031 exchange. You sell, roll the proceeds into a new property, and then do it again. Accelerated depreciation, cost segregation studies depreciate the maximum possible out of that property, keep it for 3, 4, 5 years, and then do another 1031 exchange, etc. So people do this. This is a legit strategy, and you can continue to reap tax benefits, massive tax benefits, and get a ton of cash flow while also avoiding paying gains on your gains of the property, right? On the value of the properties. and you can continue to push this down the road. Now, if you do this indefinitely to the point you have your last property, you have probably at that point multiple properties, you still have not been taxed on the gains. Remember, if you die and you leave these properties, right, to your heirs, it goes to your trust. Ideally, they're in LLCs, they're owned by a trust, and it passes on to individuals, children or other heirs, then they most likely can qualify for a step up in cost basis. So even though they depreciated these properties to zero, if it steps up to the fair market value, then they can go sell the properties, realize no capital gains, and then you've essentially avoided paying capital gains for decades. This is what real estate can do. So 1031 exchanges are fantastic. They are complex, and there are a lot of rules that govern this to make sure you don't blow it up. So work with a tax professional. Okay, just do it the right way. So that pretty much wraps up the 1031 exchange. Now, I just want to caveat this by saying 1031 exchanges are beloved by real estate investors. And there are a lot of people that hate them because you're deferring gains all the time, right? There's even other types of properties you can invest in that are opportunity zones, areas where they want to incentivize investment. Maybe it's low-income housing or things like that, where you can do a similar idea. If you reinvest gains into opportunity zones, then you can also defer the gains. Okay, so there are tax advantages there. But there's a lot of politicians, especially, that do not like 1031 exchanges. It's been on the chopping block more than once in new tax legislation that's been proposed. So the 1031 exchange could get axed at some point, but as of now, it is still around and kicking. All right, so that wraps up this video. We'll move on to the next topic.
Keep your money working longer.